new norm in the market will be chaos. We all need to get comfortable with uncertainty because we'll have plenty of it. We need to think exponentially and act incrementally. Markets are up, I think, about 8%, but if history is any guidance, I'm not so sure that the bed is over. Since 1950, we had 11 market corrections of 12% or more in a bull market. What I wanted to talk also is about Apple. The way Apple goes, it seems like the rest of the market goes. We got some disappointing numbers. Their revenues are going to be $84 billion for the December quarter. That was a disappointment, and they attributed the shortfall in revenues mostly to China, and not just China, Hong Kong, Indonesia, and other countries in that region. In the past, we already saw cycles where the refresh of new products wasn't working according to schedule. To mention a few cycles, they came out with the 5C, if you guys remember, years back. So that was a disappointment. Then the news cycle that came right thereafter was the iPhone 6 with the large screen. So that was an extremely good product for them. Then the iPhone 6S was another disappointment. And the news cycle of the X and the XR, I don't think has enough features to push us, the consumers, to get out of the existing iPhones that we have, the 6 and the 6 Plus and the 7. At the end, they manage always to come out of it. So Apple will rely less and less on their unit sales and more on their services. Let's not forget for a second that Apple has a fortress balance sheet of $130 billion net of debt cash on their books. They have a lot of customer loyalty, tremendous stickiness in their ecosystem, and they are selling now today at 12 times earnings, Apple, which is very cheap because the S&P 500 is selling at about 14 times earnings right now. If we take into account the earnings per share that they are expected to make in 2019, which is $12.24, and we give them an average multiple of what Apple used to sell in the past, to be exact 13.6 times earnings, in 2019, that puts the stock at $166 a share. So if we were to add the $27 per share in cash, we get to a number close to $200 a share. So this is the opportunity, even in a market where most analysts already downgraded the unit sales for Apple, revenues for Apple. The street is giving them, at this point, just about zero growth rates. And I don't think that this is the case with Apple. An analyst over the weekend from RBC, Royal Bank of Canada, said that even if their unit sales will flatline because of their other businesses, their services, they will still grow at about 10% per year. And then there is always the opportunity that they will have a strong refresh product cycle coming in, and 5G that is going to be launched in big volume in 2020, 2021 can also help new products with Apple computers. In the last 10 years, growth stocks outperformed value stocks. The value companies are these companies that sell at 10 times earnings or less. If you look at the S&P 500, 103 companies just about are selling at 10 times earnings and lower. And if we were to think about value stocks, some of the value plays that come to mind can be companies like AT&T, the telecom sector. AT&T last year was down 30%, paying today 6.5% dividend. The negative for AT&T is that they have about $180 billion in debt on their books. There is a possibility that the dividend will be maintained, so the cash flow at $26 billion covers the dividend at $14 billion per year, 185%. Now you can buy a company selling at 8 times earnings as opposed to the market selling at 14 times earnings. If you look at the banking sector, you find also some companies there that are paying 3% dividend, selling at less than 10 times earnings, and the names that come to mind is Citigroup and Morgan Stanley, each selling at 8 times earnings, paying north of 3% dividend, and selling at less than book value. Also, some of the industrial names look attractive. That includes Caterpillar and United Technologies. So I would expect 8% corporate growth rate, and therefore, in my view, the market is quite oversold.
Consumer spending is very strong, and it was shown in the Christmas holiday. Business spending also is projected to be 4.9% higher than it was last year. Why? because labor markets are very tight. But I see some negatives out there, like trade dispute with China is still hanging out there. The housing market, which is a very large part of our segment, also is weak because of interest rate rises. And the unemployment rate is at full employment. There's boom-bust cycles in the technology area.
I said in the beginning, markets go from one extreme to another. Manufacturing in China indicated that they are contracting, and the market was down 700-800 points, and the sky was falling. And then the following day came in on a Friday, and we got numbers on the economy. The economy generated over 300,000 jobs, and the unemployment actually went from 3.7 to 3.9%, only because more and more people that were sitting on the sidelines decided to go back into the labor force, and the participation rate, which historically was very low, moved up towards 63%, and we went up 800 points in one day.
I have an update on the cannabis market. AB InBev, the parent company of Budweiser, concluded an interesting deal with Tilray. We'll remember that Altria invested $1.8 billion into Cronos not too long ago, and Constellation put $4 billion into Canopy Growth. So AB InBev came in with Tilray, and they decided on a joint venture of $100 million, where they're each putting in $50 million to develop a cannabis-infused non-alcoholic beverage, which I find is a really interesting ploy for them to come in for $50 million to get into the space, as opposed to the other companies that are making these billion-dollar investments. It's great from an institutional standpoint, but from the retail standpoint, we always have to keep in mind that these companies have a lot of issues. We still have Rule 280E with the IRS, where the IRS states that it's illegal for these companies to deduct any of their selling costs. There's still banking issues with the major banks where it's still federally illegal. So from a individual investor standpoint, there's still a lot of risk. Most of these companies are missing all of their revenue projections.
Just to keep our fingers on the pulse of the yield curve and what's going on there. If you remember back in about mid-December, we had a temporary inversion on the 3-year to the 5-year. It did correct itself, and as of right now, there's a 2 basis point increase between the 3-year and the 5-year. The 2-year to the 10-year almost inverted last week. Back in 1998, there was a similar scenario where we came close to an inversion, but it didn't actually take place. And the 2 years after that, the market was positive for another 2-year period. So again, we got to keep in mind that the average inversion to recession has averaged 18 months, which still would put us at the first quarter or second quarter of 2020. If those numbers hold true, the consensus that I've seen again is that in 2019 a recession is unlikely. We're entering that 3rd year of the presidential cycle. In the last 80 years, there's only been one time that the 3rd year of a presidential cycle has not been positive for the S&P 500. So all those factors, there's a lot of room for growth in the market still.
Hello everybody, and thank you again for watching our videos. I'm Amit Stavinsky, the Managing Director of Tamar Securities and its affiliates, 911 Financial Services and Firefighters United. If you like the content, please sign up to our website at tamarsecurities.com, or just go to our YouTube channel and become a subscriber. The highlight of the week is that during volatile times, chaos is the norm. Think exponentially, but act incrementally.